Okay, I'll do a quick intro. My name is Janine Winters. My pronouns are she, her. I am the admin and volunteer coordinator for Oregon Pride in Business. I'm Loki, your host tonight. Thank you very much for joining us. Christine Buckley is our presenter. She is the director of the Loan Readiness Center at Business Impact Northwest. And we're going to talk about making strategic financial decisions. So thank you, Christine.
Yes, thank you for having me. It's great to be here. Yes, again, my name's Christine, and I've been an entrepreneur, small business owner, and then I moved into working with women's business centers through that are supported by the SBA, and joined Business Impact Northwest about 3 years ago, and joined the COVID response team. So I was helping businesses navigate COVID, the pandemic, recovery ready, governor's orders, the PPP idle. And then from there went to develop the Loan Readiness Center because we saw that there was a lot of barriers for small businesses to access funding. And so that's how the Loan Readiness Center started. But I'll talk a little bit more about that in a minute. Just a brief overview about Business Impact Northwest. So we provide coaching, classes, trainings for underserved entrepreneurs. And we've been doing this. We started in the Seattle area since 1997, and now we have expanded throughout Washington, Oregon, Idaho, and Alaska. And so our mission really is to grow businesses that create jobs in underserved communities, those communities that have not had the privileges or the access to training, coaching, advising, and funding. And our vision is that all owners, business owners, have the equal opportunity to succeed. So, and we do our work with the values of integrity, community, inclusivity, and celebration. We really love to celebrate our businesses and that we feel are ours, but they're not ours, but they're our community's businesses. And our focus areas, among our focus areas are women, veterans, communities of colors, BIPOC, LGBTQ+, immigrants, and rural. Business Impact Northwest has two main components. One is our lending department. So we are a CDFI lender. That's a community development financial institution. It's kind of an alternative type of funder. And again, we are most interested in getting funds into disadvantaged communities as opposed to making money off of interest rates on loans. We also have a side to us that we do technical advising or coaching, and we do that under the umbrellas of different programs. So we have two women's business center, one in Washington, one in Alaska. Again, those are supported by the Small Business Administration. We have two VBOCs. Those are the Veteran Business Outreach Centers that serve our veteran and their spouses communities. We have the Food Business Resource Center for any business that is involved with food, either producing it on a farm or delivering it in a restaurant and everything in between. And we have the Oregon Minority Business Development Agency and the Loan Readiness Center. And again, our mission is to lower those barriers, and we do that through advising and trainings. So tonight, the topics that we're going to be covering are we're going to be talking about financial statements, managing cash flow, talking about assets, accessing funding, and managing debt. And I don't know if any of you were lucky enough to attend Danielle's presentation last week, but she talked about the importance of record keeping and keeping track of your business's money, and if that is indicating whether your business is doing well or not so well. And as we know, no money, no mission, and basically no business. So running out of money is the definition of a failed business. And really, she talked a lot about the how to keep your records clean, audits, all kinds of things, how to stay out of trouble. And, as a business owner myself, I know there's enough expenses. We already have enough expenses. So why add to those long list of expenses with late fees and penalties that a lot of businesses, a lot of people I talk to and I see get into trouble because they just weren't paying attention to what was going on with their money. So let's talk a little bit about financial statements. And again, I'm just going to elaborate. Daniel did cover a few of the things I'm going to talk about tonight, but I'm also going to elaborate a little bit more on them. And by the way, we have a small group. At any time you have any questions in the chat, feel free to interrupt me, and Janine is going to do the same. I'm happy to answer questions as we go along. So basically, financial statements are presentations of financial transactions. So written records that convey the business activity, so the ins and outs of what's going on in your business. So it's a recording of those transactions that you have on a daily basis with money going in from your clients and going out through expenses. And it also indicates the financial performance of your company. So they're also used by government agencies, accountants and firms, etc., to audit your business. Also, they're used to ensure the accuracy for tax reporting, financing, or investing purposes. So really, financial statements are the storybook of your business. Really, it's where you want to go to find out what is happening with your business. How is your business doing? Financial statements also identify these things. So if you can't measure the performance of your business, you can't manage it. If you want to be profitable, you must be able to measure business performance. So credit decisions, lenders use entire sets of information in the financials. So they're looking at the financials to get information they need to determine whether they want to lend to you. So how do you manage your money? Do you have money to pay back the loan? Also, your financial statements will help with investment decisions. So investors, if you've ever wanted to approach an investor, angel or otherwise, to help inject money into your business, they are also going to use that information to decide whether they want to work with you and invest and take a risk in your business. Probably the most familiar one for most of us and you are taxation decisions. So the financial statements that you produce are going to make the decision on how much tax you pay. What's your tax liability? Also, for the owners, the financial statements are going to tell the position. What do I mean by that? And that's really what are the results of your efforts and where do you lie? So are you doing well? Are you growing? Are you in decline? You put a lot of work into your businesses on a day-to-day basis. I know, Robin, Corey, you are working hard with your clients one-on-one, delivering, what they need. And so how do you know if all that effort, those hours you put into your business are achieving what you want financially? Also, financial statements are really the basis of any management decision, and I'll get into financial management in just a minute. So financial statements identify many things, but these are some of the things that are most probably pertinent and interesting to business owners. Where is the money? And what do I mean by that? You're probably thinking, well, it's in the bank, right? No, not necessarily. It might be tied up in inventory. How would you know? You wouldn't know that unless you had a record of it in a financial statement. Maybe it's tied up in a loan to somebody else, to another business, for example. So where is your money and what is it doing? Again, Is your money creating maybe some income? Are you using some of your business money or assets to loan to others and then increasing your income? Or is it just going out the door and you're not sure and you're not exactly sure how much you're paying in expenses? You're making a lot of money, but you're not sure what your profit level is. Well, that's what your financial statements will help you identify. They can also help identify what's going right and wrong within the business. And this, of course, is based on your goals, based on what you want to do as a business owner with your business. Where are opportunities for growth? And do I have the ability to grow? You may have identified an opportunity out in the community or out in the market, and you want to take advantage of that. Can you? Do you have the financial resources to be able to do that? Go after another contract, maybe expand into another city, maybe open another location because you're seeing demand grow. Can you respond to that? Or are you going to miss out because you're not financially ready to take advantage of that? And your competitor is. So you might miss a really, really great opportunity. Your statements can also tell you, your numbers are going to tell you, do I need to make some changes? I thought this particular contract or this particular revenue stream was great. I thought everybody loved it, but I'm seeing that, you know what, my profit level's not that great on this. So what can I change? Why are my expenses in this category so high? This looks a little strange. Maybe I need to lower my expenses. If you're like most small businesses, you probably started out with limited resources and may still have limited resources. A lot of small businesses need to bootstrap when they get started. So we need to be good stewards of the limited resources that we have in our business. And then, of course, the one that a lot of us are concerned about is, am I as profitable as I need or want to reach my particular goals in my business? Again, Danielle touched a little bit on the financial statements, and you're probably aware of all these financial statements. I'm just going to go over them again briefly. This first one is your income statements. And the thing I want to point out is how these work independently and how they work together, because all three financial statements need to be looked at together. They influence each other. So the income statement, this is the one I see businesses obviously the most familiar with. They use it the most, they look at it the most often, and this is because they want to see what their bottom line is. Am I making money? And so this is a period of time. It could be any period of time. It could be from the beginning of the week to the end of the week, the beginning of the month to the end of the month, beginning of the year to the end of the year. So period of time, and that will indicate your financial performance. So how are you doing? What's your profit? Are you profitable? Next one is the balance sheet. This is a snapshot in time. So when you produce a balance sheet from your accounting system, this will be that moment you produce it. So if I run a balance sheet right now, and do it again tomorrow at the same time, it may be very different because there may have been some transactions that happened tomorrow in the morning. So I might have, gotten a loan, or my inventory might have changed. This is the financial statement that a lot of people look at to see what your company is worth. So what the company owes and what it owns and what's left over, basically. The cash flow statements, which I feel is the most neglected and the most important financial statements. And that's this one that should be looked at. It includes things that are on your balance sheet and your income statement. So it's kind of an intersection. And the way this one works is it's a change between periods. So it includes money coming in and money going out at the same time between a period. So you're looking at movement, and I'm going to explain cash flow a little bit more in just a minute. These are some very simple examples of financial statements. Of course, they all look different when you run them from your accounting system, depending on what accounting system you're using. But they all contain basically the same items. The categories will be different depending on how you or your accountant sets up what's called the chart of accounts. But basically, they'll have at the top your revenues. So it might be just a gross number, or you may put these in different categories. After that, there's called cost of goods sold, and that's usually if you have a type of business model that you need to purchase things and you resell them. You do something to them and you resell them. So you buy some t-shirts in bulk, you add a graphic design on them, and then you resell them. You could as a service business, you may have what's called cost of services. A lot of service businesses don't have a lot of those. It's usually just labor. So it's anything that it goes directly to your clients for the price you're charging them. So as a service business, if you're actually like, I had a consultancy business. So I was meeting with people, but I would give them things on a thumb drive. I purchased the thumb drive, gave it to them. So that was a cost to me. So that was a cost of service. I would also give them a manual or a report in a binder. And so the paper, ink, binder, that would be a cost of service for me. So take the revenue minus your cost of goods, and that's your gross profit. So that's what you're basically making on your revenue streams. But the business has all kinds of other expenses, as you know. Government wants your taxes, the utility companies want something, you need insurance, you're going to need to have a website. So all of those business expenses now come out. And then after that, if you have a loan, there might be some interest expense on there too. So the bottom line comes down to net profits. So that's what most business owners are looking at. And the interest expense and earnings before income tax, if you know what EBITDA is, that's what that is. The next one, Danielle did talk about this because it's part of the accounting equation, part of the debits and credits that she talked about. So this is the balance sheet. Balance sheet is your assets equal liabilities and owner's equity. Or if you want to say it's equals, if you do a little bit of math, take the liabilities to the left side of the equation, you got assets minus liabilities equals owner equity. So basically what the business owns at the top, and those are assets, what they owe to somebody else, and then what's left over. So you have some retained earnings that comes from your profit and loss. So that would be your net profit that comes over. Those two numbers should equal. Anything, a draw, anything the owners might take out of the business. And there's some other categories. Again, this is a very simple balance sheet. Yours may look a little different depending on how your accountant has it set up in your business model. Of course, these need to balance. I'm always amazed at how many balance sheets I see that are not balanced. And so usually that's a bookkeeping accounting error. So you'd want to take that back to your bookkeeper. And finally, the cash flow statement. So cash flow is broken into three categories. So you can have money coming in and out of your business from operations. So that's the most usual one that businesses are going to be seeing. So that would be income and then money going out of the business. You may have some money coming in and out from investing. You may have a loan, or you may buy some equipment, or you may have some money coming in and going out through financing. So this tells a better and bigger picture than just your profit and loss, because it includes these other activities. So investing and financing. So that's where the balance sheet comes in, income statement information here. And you may see on different cash flow statements, numbers either in parentheses or negative or in red. That is decreasing your cash. So for example, when we see this $30,000 in inventory, it means the inventory value increased by $30,000. But where did you get the money to buy that inventory, those costs of goods? Where did you get it? Came out of your bank account. So that's a decrease in your financing, in your cash flow. Black is a increase in cash. So the $20,000 for depreciation is an expense on the income statement. But depreciation isn't an expense. You're not writing a check to depreciation for $20,000 and you send it and you put it in the mail or do an ACH transfer. You're not doing that. It's actually a deduction that is taken by your accountant, your CPA. And so it's not actual cash leaving. So we add it back in. We took it out on the income statement as I talked about. This cash flow statement is a combination of your income statement and your balance sheet. So we took it out on the income statement. We're putting it back here because it didn't really happen. It didn't really leave your bank account $20,000 less. So this is a more accurate, bigger picture of the entire health of your business. That's why I think the cash flow statement is one that is more telling. Has more information for a business owner. So I'm going to move on from financial statements and talk a little bit about cash flow. Cash and cash flow are two different things, and it might help to understand its movement. So you really need to know when your money is coming in and when it's going out. So there's a time element involved with cash flow. So you don't buy cogs at the same time you get paid for that thing you had to expense for cogs. So that usually happens the month before or the quarter before. You have to buy the equipment, buy the materials, buy everything, put it all together, and then you don't sell it for 3 months. So that is something that you have to be really aware of, and that's not something that your profit and loss is going to tell you. So you have a lot of things going on in your business at different times. And so the main thing to be aware of is the timing thing. So I like to visualize it like a water tank. So your business is creating cash inflow. So you're getting checks from your clients, you're billing your clients, the money's going into the bank, filling up your tank. But at the same time, money is also going out. You're writing checks for your expenses, or you're sending money to whoever is billing you. So hopefully the cash inflow pipe is big and the cash outflow pipe is small, but that's something you need to know. Like, how big is that cash inflow pipe? Is it always that big, or does it get bigger and smaller over time? Is 1 month it's really big and you get an influx of money, and then but at the same time your outflow is the same, big pipe. So that level of water or money is going up and down in your business account. You need to know when and where that money is. So I always say you should know every 6 months ahead, you should have an idea of what your cash position is going to be. You can project that, you can plan for that.
That is something I'd love to talk about later.
Yeah, great. Absolutely. Absolutely. So just making it everyone aware the difference between cash, that's just money in the bank, that's your balance in your bank, and the cash flow, which is different. So now moving on to managing your finances. So you can't really know where you're going if you don't know where you are at. So knowing your statements will really help understand the stories that your financial statements are telling you. So you may have a lot of questions and not quite understand, like, well, I have more demand than I can handle. I've got more clients, my pipeline's full. I'm getting orders all the time. People are coming into my restaurant all the time. My tables are full. I can't get any more. But why do I not have very much money in my business bank account? What's going on? Are my revenue streams profitable? So I work with a lot of businesses, like production businesses, and they have different products. For example, food products. And one they started out with, and it was kind of their bestseller, and they've stuck with it. But they're not looking at the financial statements, and they're not understanding that that is losing them money. So why is it losing them money? We don't know unless we look at the financial statements first and then see what's going on actually in the environment within the business and the management. So very, very important to always be analyzing your revenue streams if they're profitable. I worked with a remodeling company, making money, had a waiting list, all of that great stuff, had enough people asking him to, redo their bathrooms and their kitchens. But he always seemed like, it was hard to get another crew, and it was all hard to give the employees a raise, and he just didn't understand it until he realized that, number one, his bidding wasn't great. He was underbidding to try and be competitive, but then also bathrooms were not actually the best profitable. Kitchens were more profitable because a lot of people wanted to move things around in the bathroom, and moving plumbing around in a bathroom can be very expensive. So he wouldn't have known that if he didn't look at what it cost him to do a bathroom and what he was making. Why am I having difficulty getting funding or investors? Well, they know how to read your financial statements and see if you can be a good risk, if they want to invest in you. But if you don't, that might be a question, like, well, wait a minute, why aren't they giving me a loan? Why aren't they approving me? And another question, can I sell my business for profit? Depending on what your exit strategy is, are you going to pass it on? Are you just going to close it when you're done with it? Are you going to try and sell it? Well, you will be surprised at the time you want to sell your business if you haven't been paying attention to the value on your balance sheet. So you may not be able to sell it for the amount you wanted to. And then how can you leverage that money you have to meet your next goal? And also, why is managing your finances important? It really is the driver of growth and stability. For younger companies, it's more about stability. It's more about survival as you get through those 5-year mark. And then after that, it's all about growth. So doing your finances, keeping up with your finances, understanding your finances, eliminates guessing. A lot of clients come to me and say, hey, I think I want to do this, or I think I might need a loan, or I'm, thinking about expanding into this market, or maybe I should get a district, all these questions. And they stay up at night just going back and forth and talking to their business partner or their spouses, and they don't know what to do. And the answers in their financial statements, or it's in doing some projections, budgets, and forecasting. You can avoid mistakes. Overspending is one of them. Another issue I see with businesses getting also denied for loans is the owners take out more than they have to take out. Again, they see that they have made profit, and so they're like, hey, everybody gets a bonus this year, you know, all the owners get a bonus. And then it turns out that then they run into negative equity because they took out too much money. They weren't looking at their balance sheet. It helps with solvency during changing conditions. So a lot of businesses that survived the pandemic were those that were able to pivot, do something else, or they were already on top of their finances and they understood their finances. It creates financial independence. It also helps with allocating those limited resources for maximum gain. And it provides assets for emergencies. So if you have assets on your books, on your balance sheet, those can be liquidated in case of an emergency. One thing also to keep in mind too is that profits really are used for one of three things. One is to pay the owners. So that's where if you're not on salary or you have shareholders, that's where that comes from profit. Pay back a loan with that money, or keep it in the business. So basically keep it in the bank account. So when you're also looking at your profit and loss and you say, hey, it looks like we're doing good. Well, what does that mean? We're doing good so we can pay our shareholders, pay our owners. We're doing good because we can pay that loan off early, or we can put it back in the business and invest in a piece of equipment. So that profit level, you know, again, you need to know what is success for you as a business owner. And managing finances sometimes is all about good habits and creating some good habits, a little bit of discipline. I know most business owners, this is not the first thing they want to do. They want to do what they're good at. They want to do what they're passionate about. Unless you're Danielle, and she obviously created a business out of doing this. So unless you're a CPA or an accountant or a bookkeeper, sometimes it is hard to set aside some time to really understand and work with your numbers. So definitely, if you do your books, or if you have an accountant or bookkeeper do your books, make sure they're reconciled every month. Again, Danielle talked about this last time, and if you weren't there, I believe there's a recording so you can see that. If you don't have a good CPA, bookkeeper, accountant on your team, really, really recommend that you do. Not just someone to pay your taxes once a year. That's great. That's a really valuable service. I would not want to do it myself. But they're going to perhaps not help you understand your finances. So if you can find an accountant or a bookkeeper that can actually produce financial statements for you, if you can't, maybe help you or identify some expenses that might be off, that's even better. So as you know, it's really important to have a good team, insurance agents, lawyer, accountants, a mentor, a coach. So be sure to include your financial people in that team. Review your financial statements and understand them. The Loan Readiness Center and our free advisors are available to help you do that. And then make adjustments. So this is the time after you've done your financial statements and some analysis is to make some adjustments. And then you want to do some budgeting, projecting, and forecasting. Again, you'll want to know what your financial position is going to be in about 6 months. All right, just had to take a little cough and a drink of water. Now I'm going to move on to talk about assets. Again, not something that's talked about too much, but it's really important to understand what they are and how to best manage and use them in your business. Again, assets are in your financial statements. I think I gave you a clue early on which one it's on. Assets are anything of value that can increase your productivity or sales. So they can be physical, the obvious ones, real estate, equipment, vehicles, your inventory, things that you can sell. Other things that are maybe not so obvious are intangible. That could be any intellectual property or goodwill that you have in your business. And another intangible one, I mean, it's somewhat tangible and intangible, is the brain power of your employees or the owners or advisors or board members or anybody that you have that is working with you in your business. Most of your assets are on the balance sheet, and those are itemized and have a value which is assigned to them on the balance sheet. They are either current or non-current. Current means they can be converted into cash within a year, so that is more liquid. They can be written off and depreciated or expensed. And they're also listed in order of liquidity. So on the balance sheet in the section on the assets, you have cash first. That's already liquid. And then you will have probably inventory that will be, you have to sell that asset. So then the harder it is to convert it into cash, it goes down the line. The value of your assets should be and can be determined by an appraiser. This may be very important when you or if you want to sell your business. So you most likely, your balance sheet will tell the investor or the person who wants to buy your business what you're valuing your assets at, but most likely you'll need to have an appraisal. And so business asset accounting is arguably one of the most important jobs of company management. You have invested money into these things to buy them or to train them or make them productive, such as an employee, or you've trained them, you've given them professional development. I'm not going to go into ratios. I'm going to talk about doing financial analysis, but not going to go into the ratio analysis. That's a whole nother class. But one that is associated with assets that's important is your return on net assets. Basically is asking, how effective are you utilizing the value of these assets to produce revenues, basically? Why are assets important? They provide backup, as I mentioned. You can liquidate something in case of emergency. It can improve cash flow and it fuels growth. So basically, also it increases the business's value. You can generate or improve your cash flow with assets. Let's say you have on your balance sheets a large amount of assets in the form of inventory. So when I talk with people and they are in a cash flow crunch, they're not, they're just not having enough cash flow. That's one of the first places I look on their balance sheet. If they have a lot of inventory stuck either in a warehouse or on the shelf, it's like that's the first place I look. They might also have a lot of accounts receivable, so money owed to them. And so I'll say, hey, we can quickly improve your cash flow situation by calling up these people and asking them to pay you. Just say, hey, Joe, I sent you an invoice last week. I've got some my expenses. Can you, oh, I forgot. Yeah, sure. I'll get the checks in the mail type of thing. I've had clients that thought they were literally going to go under, staying afloat just from one month to the other, just by doing those two things. Facilitate business operations. Obviously, a piece of machinery is going to make production a lot easier, not much faster. It also is going to attract investors and lenders and facilitate business operations. Asset management can also identify waste, improve utilization, efficiency and performance, and helps with better inventory management. The example that I just gave is just one. Okay, now I'm going to move on to funding, access to funding for businesses. This is, again, another big topic, but I'm going to start off by why would I potentially need a loan, or why would my business potentially need to go outside to ask for a loan? Usually it's because the business needs a large ticket item. That's usually in the form of property, equipment, renovations. Small businesses don't have that financial power or money in the bank to be able to pay for these things with cash. It's much like a mortgage. Few of us can pay cash for a home, especially up in the Seattle area or down in California, where Janine and I are from. So that would be the most recognizable reason that you as a business owner would also need a loan. You don't have enough savings, either personal savings or business savings. Don't have the right type of business for equity investors. So not all equity investors are interested in every type of business model. So usually they're looking for businesses that are going to grow rapidly and expand their market rapidly, and most likely are going to sell the business within 10 years so the investors can get their investment back. You may have temporary cash flow issues. This could be for several reasons. You may just be a seasonal type of business. So landscapers, for example, very typical that they make a lot of money in the summer and don't make much money in the winter. So they may still need to keep people on payroll during the slow times. So they may have a temporary cash flow. Refinance higher interest loans. Unfortunately, during the pandemic, a lot of businesses had to rely on higher interest loans just to get through and survive. And now they're looking to refinance those at a lower rate. Working capital to get started or expand. So that's usually you might need, a crew. You might need employees for your restaurant to get started. Or now it's just been you doing most of the work, and you're ready to meet the demand, your increased demand, and so you need to hire some employees. You need cogs or materials or crews now, and you get paid later. Again, very typical in construction type of businesses. Where to get loans? It also depends on the stage of businesses. So businesses that are just starting out do not have a track record of revenues, usually are getting the funding from their personal bank accounts or peer-to-peer, or maybe a loan from a family or friend. Most of it comes from that. As they start generating revenue, then businesses can start looking to commercial banks, credit unions, community lenders, nonprofits such as Business Impact Northwest. Also, there's an increase in fintech. So these are online lenders. A word of caution on those, please do your diligence if you're considering that type of lending. Not all of them are bad. There are some very fine type of online lenders. I mean, we are kind of an online lender because the application is online. But just read the fine print. Make sure you know what the interest rates are and the terms are. If they promise to fund you in 24 hours, I would be very suspicious because they're not doing their due diligence. They're not assessing your risk as a borrower. And that way they're going to make that up. That risk is going to be made up in the form of interest, higher interest rates to you. So just a little bit of caution. Lots of type of lenders, lots of type of loans. So there's small business loans, there's commercial loans. Those would be from larger banks, national banks, cash advanced, SBA loans, business lines of credit, real estate, equipment financing, franchise and disaster loans. So lots of different types of loans. You want to make sure that you first understand what you need, how much you need, why you need it, what you're going to use it for. And then from there, you can start researching the types of loans, the type of products that different types of lenders have. And again, you can meet with one of us at the Loan Readiness Center to help you navigate that. As far as lending is if there's anything you remember from this workshop is to prepare. And it's never too early. Even if you're thinking like, Christine, I have no desire to get outside funding, no desire to get a loan. You most likely at some point will consider it. I'm not saying you will get it, but you will consider it. And the worst time to apply for a loan is when you're in a cash flow crisis, when you actually need, the saying, when you really need the money, that's the worst time to ask for it. So think and plan ahead. Again, that goes back to your financial management. So part of your financial management is not just understanding what's happening with your money right now. It's also knowing what is going to happen down the line. Know if you potentially are going to need outside funding. So when you think about your goals and make your lists and review your year and say, how did we do? We did great in this area. We didn't meet this goal. We need to change this a little bit. Then, hey, do we need some injection of money? We want to do this in the next 6 months, or we want to do that in the next year. Does this have a price tag associated with it? If it does, then where's the money going to come from? So that's where the budget and the cash flow projections come in, and that's how you can calculate the gap. You do not want to go to a lender and say, hey, I think I need a loan. How much can you give me? The lender will go, hey, why don't you come back and, when you have a better idea of what your goals are and how much you need and what your financial position is, come back and we can talk. And this deficit may come from various sources. Some of it will come from your savings. Some of it might come from one lender and it might come from another lender. I've seen businesses use crowdsourcing to fund a project along with a loan. So it just doesn't have to be one or the other. It can also be a combination. The ability to repay a loan is a lender's main concern. It's not about making interest, making money off of you, especially the community-focused lenders. They really, of course, need to get repaid because they're getting their funds from maybe a donor or another bank, and they want to get that money back, and so that they can relend it to another small business. So they're looking at your history of paying back loans. Do you have a track record of revenues, or in the case of a startup, have a good case that you will? How are you going to generate that cash to pay back the loan? What revenue streams? Do you have experience in the industry? Basically, that experience is going to lend to your success in generating those revenues. Is there demand for your products and or services? And do you have the assets to back up the loan? So again, earlier I talked about assets. This is what I'm talking about, because those assets, that is going to be used as collateral. And that collateral is going to be the just in case you don't pay back the loan and the lender can get something back. The other thing a lot of lenders use, you may be familiar with the 5 C's of credit. This is kind of a scoring or a risk rating. This is how they kind of give you a risk rating. And the first one is your capacity. So they're going to look for your capacity again in your ability to show or your past ability to generate revenues. Character, that is basically your credit score and your credit report. So they're going to look at what your payment history is like. Conditions. What are the conditions in the market that you're putting your business that you're operating in? And what are the trends of that industry? Lenders know a lot about certain industries. So, for example, we have one loan officer who is very familiar with the trucking industry. And so we had one business say he was going to the first year, right out of the box, right out of the gate, he was going to make $200,000. And loan officer said, I have never had any client, I've never lent any money to any business that made that much in the first year. So you need to know that potential. Collateral is any asset you pledge to back up the loan, and capital. And that is the your own money, either from the business or your personal savings to pay back the loan. Yeah.
So what if a huge part of your business is like consulting, selling services? I think Corey might fall in this bucket, but I fall in the bucket as an engineer. And so earlier in your talk, you talked about that as an asset, brain power. So how do you value brain power in order to use that as collateral?
Unfortunately, it won't be used as collateral.
So it's not really an
Because
asset then.
yeah, because we can't, it would be a little hard to sell, like, hey, we've got, Rob, he's super smart, and let's, give him to another company and
Right.
no, and we'll take a salary. No. And this is a big barrier, actually collateral to some businesses, especially as you mentioned, to service businesses. Where that comes into play then is going to be personal collateral. So you can put up either business collateral or personal. So if you have equity in a home, equity in a vehicle, that would be counted. But it is a difficult situation for service businesses, but it's something to be aware of. So you may have to put in more of your own money into a project, whatever that project is, you may need to put in more of your own money towards that if you don't have collateral. Yeah, Corey.
Yeah, and one thing in reference to getting credit is also if there's credit unions that are specific to your industry. Like I know for insurance and investing, one of the credit unions that I use, that's all they do is work with advisors and insurance agents. And so they'll understand the business and the trends of the business. So sort of Rob, to your point of like, yeah, you can sort of tout your own expertise, but they're also going to look at like where's the industry trending. And so like if I need money and yeah, things aren't and I'm maybe things aren't going great, but they know the industry is trending up, they factor that into their lending decision. So just another avenue.
No, that's brilliant. I will have to think about what credit unions or banks would specialize in environmental engineering services, but yes,
Yeah.
it's still a good point.
I mean, it could just be like engineering, like you can sort
Yeah,
of just search for the more general category.
totally
Uh,
agree. Yeah, it's all good. This is funny.
Yeah, no, thank you for that, Corey. That's a great idea.
Corey, you had a question in the chat.
Oh yeah. So I was just going to ask Christine, do you have any experience? Because I just met somebody the other day that this is their sole business. So I was curious how much of it's out there. do you have experience in helping businesses build their business credit so they can get their credit tied to their FEIN as opposed to personally secured? Because I know that's a big thing that I didn't even realize until I sat down with this person at a networking event that it was really possible. Because any business loan I've ever gotten, they're like, yep, and sign here, and here's your social, and we'll take your house if we want. So, which is a lot of what you've been discussing. So, do you have any
Right.
experience in getting that tied to your FEIN?
Yeah, again, most lenders are looking at the personal because the owners are they're the CFOs. So they're making the decisions. Now when it comes to businesses that are mostly shareholders, right? Bigger corporations, that might be a different thing. But for most small businesses, they're still looking at the personal credit. So I'm not saying that lenders don't look at your business credit as well. They do, some of them do. But a lot of businesses don't work on their business credit because they don't really need to. So where business credit comes into play is when you are working with a vendor and you need terms, and that vendor wants to know if you are a good risk to do that. So, yeah, for now, again, most lenders that I know of, credit unions, large commercial banks, CDFIs are still working with smaller businesses, and they're looking at the owners. So anyone 20% or more.
Yeah, I'd love to chat separately and even maybe connect you to him just because I think it could be a valuable resource. Because even from
Absolutely.
the brief conversation that I had with him, I mean, you mentioned like trucking, like even construction. These were very small businesses, so he wasn't referring just to large businesses, but even the difference in, and it takes, I think, at least a year for them to like build that up because just like personal credit, you have to like start really small. And
Right.
he was saying that like, oh yeah, like the interest rate for purchasing a business vehicle for like a contractor is like 1% compared to like you just buying it personally, which is what every credit union does and gouges you at 8 or 10% or something, whatever the going rate.
Right.
So
I
yeah, I
would
Yeah,
can
love,
tell him
I
absolutely.
would love to know more about this topic of how to build your business credit. I mean, my business is only 14 months old, but I have plenty of opportunities to grow.
yeah.
And
Yeah, I'll go off video for a second and find his card, and then I can put the information in the chat just so I just met him at a networking event. I have no affiliation to him, but
Right.
just what he was explaining sounded very interesting, and they've had a lot of success helping out. I mean, that's all they're trying to do is help small business owners. So,
Yeah, fantastic.
yeah.
Yeah, thanks for sharing that.
yeah, thanks.
So speaking of credit scores, which I'm thinking that was a good segue. So as you probably all know, they're monitored by 3 credit bureaus, and they're scored from 0 to 800. Business credit scores are monitored by Equifax and Dun and Bradstreet, but Experian also has a business credit scoring model. Different scoring. And as I mentioned, lenders will generally only look at personal scores, and vendors may use business scores. Your credit report is basically the information that your credit score is based on. So there's an algorithm, and if you have pulled your credit reports, there's different types. So there's different scoring models or algorithms. So there's the FICO 8, there's the FICO 10, there's the FICO for auto, there's a FICO for mortgages. So different lenders use different scoring systems. In my experience, they're very similar. So you're not going to get a totally different score. Where you may get a different score is if you use these third-party type of scoring, Credit Karma or your bank app might give you your credit score. Those may be a little different than if you pull your credit score from one of the bureaus. So basically your credit report is going to show your payment history, delinquencies, charge-off, bankruptcies, lengths and types of credit, numbers of inquiries, and how recent. And you can see that your score is weighted most heavily on your payment history. So, pay on time every time is the rule to keep your score up. And then don't max out your credit, what's available to you. That's the second most common reason that your credit score is going to go down. Speaking of collateral, again, it is difficult for service businesses, but basically collateral is going to be one of those assets that I talked about earlier. It's usually taken at a 1-to-1 rate. So if you want a loan for 100,000, you're going to need $100,000 in collateral to back that loan up. It just reduces the risk for the lender, and they're more likely to approve a loan. You'll need to keep in mind that 1-to-1 is on a discounted basis. So some of those assets are going to be discounted. So let's say you say, I have a car that's market value is 15,000. Well, the lender is going to say, well, for us to have to repo that car, store it, get it up into condition to sell it, then put it to auction, that's going to cost us $5,000. One thing though, most lenders, this is the last thing they want to do. So I have clients that say, I do not want to give a personal guarantee. A lot of lenders are going to ask for a personal guarantee. I don't want to risk my home. The lender's going to say, number one, if you don't want to risk your home, that doesn't give us a good feeling. It doesn't sound like you have a lot of faith in your business to generate the revenues to pay back this loan, first of all. And then they're going to say, that's going to be the last thing we do is try to, take your home. We will work with you. We will lower your payments. We will go interest free. We'll do whatever we can. Yeah, Rob, did you have a comment?
I don't know. I just think that's unethical for
Oh, which
banks
one?
to be having that attitude that if you don't want to put your house up or you don't want to put up whatever, that somehow you're not worthy of lending to or whatever. That's a very convenient thing for them to be saying from their position.
Yeah, well, yeah, I can understand that. It's really not, you're not worthy. That's not what they're saying. They're saying that, if we're going to put our money into your business, we are putting our faith into your business. We're saying, yes, we believe in your business. Yes, we want this money that we're lending you to help you succeed, grow. And, we're not lending so your business doesn't succeed.
Right.
The lenders are saying, we are in this with you. We are putting our money. So if you don't feel confident enough to put something of, skin in the game, the question would probably why. They're going to ask why. So
There's a difference between skin in the game versus putting up your house.
That's skin in the game. Yeah, that's skin in the game.
That's one choice of skin in the game.
Yeah.
Like you could have an IRA that has $1 million in it, and you might put that up.
Right.
You'd pay a penalty, obviously, if you had to take it out. But
yeah.
I'm just saying there are other ways to have skin in the game.
Right. Then other than the place you live, right? The roof over your head. Yeah. So how much capital? There's also something you'll need to put in. Again, this is part of what I was just speaking to, is what is your portion of the project? So let's say you want to do something, it's going to cost you 100,000. What can you put down? And so that portion depends on the loan size. So obviously, the larger the loan, you're going to put more into that project. Usually it's between 10 and 20%, very similar to a mortgage. It depends on your credit score. So if you don't have a great history payment or you're riskier that way, then you might have to put down a little more. It depends on the type of loan and the type of lender as well. I spoke about capacity as one of the 5 C's. And what does that mean? So it's the demonstration of enough revenue to support operations and debts. So lenders or investors are going to look again at your business financials. So they're going to look for your revenues in your income statements. They're probably going to want to look farther back than just 1 year. They might look back 3 years. They're going to look at your capacity as far as your liquidity on your balance sheets. So how much liquid assets do you have as opposed to non-liquid assets? They're going to look at your tax returns, cash flow projections if you are a startup, and they may also require some bank statements. What our lenders are looking for in different documents. So when you apply, they're going to request a lot of information from you. So it's not quite as straightforward as a mortgage, where all they need to know is what your steady income. They need to know that in the next 2 years, you're going to have a steady income, whether it's from a W-2 or self-employment income to pay back the loan. For businesses, that's a little different. Income is not as necessarily as steady as a W-2. So they're going to be looking in your business plan, if you're a startup, or your loan proposal, that it's a viable model and makes sense. It's well researched. You have the experience. You have a good management team. This is something that is sustainable and it has growth potential. In your finances, they're going to be looking at how much equity you have, how much cash in the bank or accounts receivable. What is your profitability? Now, again, they might do some ratios on that. Debt burden, are you already highly leveraged? Lenders do not want to burden you with another loan. That's not in your interest whatsoever. So what's your debt loan to value, and also your debt to income? Do you have collateral, and what's that value? And of course, your history of repayment. Just a brief overview of some documentation that you will probably need to have ready or prepared to show when you start talking to your banker or your lender, loan officer. Business plan or a loan proposal, proof of collateral and a down payment, financial statements, financial projections, resumes, or just basically a bio experience of anyone owning 20% or more of the business and personal tax returns, and any type of documentation that would be needed depending on, again, on the use of loan funds. So if you are putting your house down as collateral, they want to see your mortgage statements, personal bank statements. They may need to see if you're buying a business, they need to see the finances of the current business owner and current business and evaluation of that business. If you're buying equipment, they'll probably need to see a purchase order on that equipment to make sure that what you're saying it's worth is actually what it's worth.
Does the bank care if you're considered an accredited investor?
That's a good question. Yeah, I do not know. Yeah. I would have to.
Because a lot of times you have to submit a lot of this stuff to a third party accreditation company, and then you're approved for, say, 5 years or something.
Yeah.
Not that I wouldn't want to provide it to the bank. I'm just saying it seems like the bank would benefit from knowing that.
Yeah, definitely. I don't know how they would take, like, how a loan officer or underwriter would weigh that in their decision. Honestly, I wouldn't know, but it certainly doesn't hurt to have that. And these are things I pretty much already talked about when I talked about being prepared. You know, have your books in order, understand your financial statements and position, understand the reasons why you are you need a loan, what your goals are, how it's going to benefit your business, and then put numbers to those goals. Know how much outside funding you will need and how much you're going to finance the project, and prepare that capital infusion and know what collateral you will have. You also want to be cognizant of your time frame. So applying and getting approved takes some time. It can take months, depending on your preparedness, your level of preparedness, and the lender. You can talk to your business banker. You can research. You can ask us of different types of loans and lenders. Get coaching and consult with experts beforehand. Just it'll go faster. No reason to apply when you're not ready and get frustrated. And get denied and get frustrated. Put together that marketing plan, business plan. Ideally, businesses should be doing this annually anyway. Once you file your taxes and plan for the next year. Know what your risk factors are and mitigate those beforehand. So again, lenders are going to know industries. They're going to know what those risk factors are. And if you can mitigate those and lower that risk in the eyes of a lender, your chances of getting approved are more. Definitely discuss with your accountant. Tell your accountant that you are looking to apply. You do not want to take maximum deductions a year before you apply for a loan. So your accountant's doing you a favor and getting you a lower tax liability, but that doesn't look great in the eyes of a lender because it doesn't look like you're as profitable as maybe you are. And also make sure you have a updated credit report and you reviewed it, because the lender's going to pull it. So if there's anything on there that needs to be corrected or addressed, you can do that ahead of time. The reasons for denial, the biggest one is too much debt. You're just already too leveraged. And normally they don't want your debt usage to be more than 30%. And low credit score is the next. And then insufficient collateral that I already mentioned. Tips to getting approved. Prepare your documentations. Help lenders understand your business. So they really want to know more than actually what's just on the financial statements. So it sounds like it's just all about the financial statements. They want to know about who you are, where you've been, why you started your business, what you're doing in the community. Are you going to create jobs? Are you going to keep, this product in the area? What is your impact in the community? So really understand and communicate with them. Explain your numbers, how you pay off the loan. One thing I hear lenders say, especially about startups, not so much for established businesses, but it's just they're not realistic in their projections or their goals. And great time now, even again, if you're not looking to get funding, have an established relationship with your lender. They love to know their small businesses. So if you have a business bank account, stop in and talk with them, get to know them, tell them about your business, kind of what perhaps, hey, we're service businesses. What can we do? We don't have collateral in the business, if we want to get a loan. And then if they're not the right lender, they'll probably know another lender in the area that they can refer you to. Lenders work together. I get a lot of referrals from other lenders and vice versa. And also be responsive. So once you do apply, make sure that you stay in communication with your lender. And finally, once you do secure debt, really you want to manage that like all of your finances. So you really want to understand the business loans terms. Your loan officer is responsible for explaining that before and at closing. If you have trouble repaying the loan, get help. You know, there's all kinds of business organizations, service organizations such as Business Impact Northwest, Livelihood Northwest in Oregon, all kinds of agencies that we work with, free services. You know, set up things on auto pay, so you don't forget the payments, of course. Consider loan refinancing options, and also be honest with your business lender. They hate surprises, so they hate, and it breaks my heart when we get a referral from our servicing department, a business that's having difficulty for whatever reason paying their loan. You know, because the landlord increased their rent. Well, they knew about that 6 months ago, and they're coming to us now when they're getting evicted. You know, so it's like, you know, once things start to change, you know, if it changes from when you applied for the loan, your situation, just talk with your business lender. They really appreciate having that relationship and that conversation with you. And the Loan Readiness Center, we provide credit counseling. We have 2 certified credit counselors to help maintain your credit score or improve it. We also help with a little bit on the personal financial side, understanding personal budgets and personal finances. We will help understand your financial statements. So all those things we talked about tonight. We review business plans and projections specifically for those who are looking to apply for a loan, and those are requirements. And then we can also assist with all of the other underwriting requirements. So this is my contact information, and I will have this presentation available to those that registered for this webinar. So you will hopefully be able to get that in a follow-up email. Yeah, Corey.
Thanks. Yeah, I put it in the chat, but I was just realizing, I was like, why is this hurting my brain? You're like, be honest with your lender and let them know what's going on with your business. And it's been, well, I haven't had this problem, but from what I know about banks and credit unions and even the most loving of institutions, if you come to them and tell them that you're having financial difficulty, from my understanding, their job is to mitigate their risk. So they're going to cap lines of credit. Like if you have a revolving line of credit and you've got 5 of 10, they're going to drop it to 5, putting you that much more in a bind, and potentially call loans due to try to get out from underneath a sinking ship. So I am open to different interpretations, but that's my experience of, like I said, even the most friendly banks. So
Yeah, I mean, I can't argue your experience. Your experience is, your experience. I can say for most CDFIs, most, smaller credit unions, the default is the worst case scenario for them. So maybe larger banks with larger portfolios and larger loan loss reserves could do that. They could potentially say, hey, this is just going in our loan loss reserve. Smaller lenders don't have those large loan loss reserves. So they also get their loan portfolio from different places. So they CFIs get them from foundations, from donors, from other banks. So have to be really good stewards of that money. So, and our mission, if you remember, is to get the money into the community, so we take a higher risk. So our underwriting criteria is, it's not black and white. Absolutely not black and white. We look at each business separately. We look at each owner separately. We look at their situation separately. So yeah, I can't say what your experience was, but I know a lot of lenders that, yeah, no, they're not gonna just say, hey, we don't, oh, since you told us now, bye-bye. We don't want you anymore.
Got it.
That's
Well,
that's the
I'll
opposite.
take your word for it. So like I said, I haven't had personal experience with it, just from what I've heard, and just I guess, and maybe I'm speaking more from my personal experience on
Mhm.
like other financial issues, even like a home equity line of credit way back in like the 2008 crash. They like cut off any available room on a home equity line of credit and all that kind of stuff, which was, to be fair, just a big bank. So I can see how it could be easy or much different with a smaller institution.
Yeah.
If I may, the question I have is sort of related to cash flow analysis. I'm quite familiar with being able to map out all the expenses and things like that. But how often my clients pay their invoices varies considerably. Sometimes it's as quick as 2 weeks, other times it's 58 days or something, which still isn't bad. But I guess my question is when thinking about a cash flow analysis, do I just take like the average estimate on their invoicing and project that forward so that if I know I'm billing out in the month of March, that I know I won't get paid till May or June? I mean, would you have any guidance on that or a resource that I could go to? Because I feel like I'm pretty comfortable mapping out all the expenses side. It's really mapping
Right.
out, and I think there's no lack of work. So it's not like I think the income is going to dry up. It's more about the timing of it.
Exactly. Yeah. What are your payment terms with your clients? When you invoice them, do you have them on a 30, 60, 90?
Yes, it's usually 30, but here's the thing is that, being a small business, some of the projects I'm on, I'm a sub to a sub, right? And so
Mhm.
the client will pay the prime within 30 days, and then they'll pay their sub. Usually that's less than 30 days, and then they'll eventually pay me. So,
Yeah.
so it can usually be, 60 officially.
Right. Yeah. I mean, I would, you probably just have to guesstimate, but for your planning, if you're direct, if you're invoicing directly to the clients, whatever your terms are. So if you sign a contract in April and it's 30
Right,
days, then I would project May.
right.
If you're doing government contracting and you're under a prime, I would guess as best you can based on past
Fair enough.
performance, that they're going to be probably 60
Yeah,
days out. And
which
just
is
say,
fair.
okay, just sign this another contract with this prime. We're going to start in April. So most likely won't get paid until whenever. Yeah.
Yeah. Okay. There's surprises then.
Yeah. Yeah. I mean, really, that's it's better than not projecting. So it's
Yeah, I would agree with that. But I also
because
didn't want to, the one thing I don't want to do is, and I've seen the large firm that I came from would sometimes do this, where they would take all their projects and collapse them down into like workflow of how much they expect to bill each month going forward. And I just think that there's so much uncertainty with that,
right.
um, that it's not worth the exercise.
Yeah, yeah. No, I understand
So
that. Yeah. I mean, it may help you decide, in negotiations, if you have any ability to do any contract negotiations, you can say, hey, I need to start this month, like
yeah,
based a little bit on what you're going to be receiving down the line and how much you do need to receive down the line. So, um, it's good to know just for that type of planning too.
sure. Thanks.
Any other questions? I don't know. I haven't been keeping track of the chat, but I don't know if there's any questions.
Yeah, covered them as we were going. Well, thank you so much, Christine, for
Yeah, thank you so much,
your
Christine.
Yeah,
presentation.
thank
And
you.
hi, good to see everybody.
Oh, there's Frank. Mr. Frank.
Yeah, I'll send a follow-up email to you all with our recording. And if you haven't registered for next Tuesday's session with Danielle Morris about pricing and the experience economy, I recommend that. I think it's going to be fun. She said about a business finance class. Yeah, thanks. Thank you all for being here and
Yeah.
take care.
Thank you so much, Christine.
Thank
Thank you.
you.
Thank you.
Thanks, everyone.
And have a
Bye
great
now.
evening.
You too.
Bye-bye.